Hi everyone, so this is a quick video on the calculations for saving, investing and borrowing for a junior cycle business. So the first question here is a simple and compound interest question. And we're told that Tom saves €400 per year in a deposit account for 3 years and earns 5% simple interest. And Mary saves 500 per year in a deposit account for 3 years and will earn 5% compound annual rate. So what you have to do then is you have to calculate these interest rates for Tom and Mary. So Tom here is in orange and Mary here is in green. So what you need to do for Tom first is you need to look at the interest rate that Tom earns for year one. So year one, the principal is the €400 by 5%, which means per year Tom will earn €20 interest. With simple interest, it's always taken on year one. So when you're doing your workings, it's the €400 by 5% equals 20, which means per year Tom will always get €20 in interest because, as I said, it's always taken on whatever year one's is. So €400 by 5% is your principal calculation, and the interest works out at €20. So it'll be the same for year two, and it'll be the same for year three. So Tom will know how much he's going to earn per year, which will be €20. For Mary, it's slightly different. So Mary's amount will always be on what's left in the bank after her first year into her second year and her second year into her third year. So what I mean by that is if we look at year one, Mary will multiply €500 by 5% and she'll get €25. So at the end of year one, Mary has earned €25 in interest. For year two, it's always on the amount that's in the bank. So what you have to do is you have to add in the original principal, the original amount of €500 plus €25 equals €525. So now in year two, it's €525 by 5%, which is €26.25. And in year three, you're going to add the €525 plus the 26.25, and that gives you 551.25. So in year three, it's the amount that's in her bank account. 551.25 by 5% is 27.56. So her interest rate is always going to be on the amount that's in her bank account at the start of the next year. So when we add Mary's interests together, 25 plus 26.25 plus 27.56, her interest earned is €78.81. So what that means is Tom will have earned €6 in interest, adding up to 20 to 20 and the 20 together. And in the bank at the end of the term, he'll have €460 in the bank because it's the original €400 plus €60. For Mary, she will have earned €78.81 in interest, and now we'll have a total of €578.81 in the bank. So it's our original €500 plus €78.81. Question number two. This is DIRT calculation. So DIRT, remember, stands for Deposit Interest Retention Tax, and it's tax on the interest earned on your savings. So here's a typical example below. Andrew earns €180 in interest from the bank, but must pay DIRT at 33%. So you have to do is you have to calculate how much DIRT he will pay and how much money he will have left in the bank. So the first calculation, and make sure again to label this, is DIRT. And that is the total interest earned, €180 by 33%. So Andrew will pay €59.40 in DIRT. How much money will he have left in the bank? Well, it's the interest of €180 minus the €59.40 in DIRT, which means you'll have €120.60 left in the bank. Again, make sure to label your heading in that answer. Question number three. So what you're asked to do here is borrowing flat rate versus annual percentage rate. So the question here is a sum of money is borrowed €1,000 and it's to be repaid over 4 years at 5% interest per annum. Per annum means per year. Flat or 5% for the APR. So what you do here is you write out your years, year one, year two, year three, and year four. And I would like you to use the headings balance, repayment, and interest. Balance, repayment, and interest. So that's for flat rate and that's for APR. And what we know here is that they're borrowing €1,000 and that is going to be over 4 years. So in other words, what happens is that balance column you can see here, that is going to reduce by €250 per year. €1,000 divided by 4 years is 250. So basically it's reducing by 250 per year until you get to the total at the end and there's nothing left to repay. So therefore, the repayment for each year is €250 until you've repaid your €1,000 here. And you'll notice on the APR side, I've done the exact same. The balance to reduce by €250 per year, and the repayment is €250 per year until you get 1,000 paid back. To work out the interest, so on the flat rate, the interest is always going to be on year one. So €1,000 by 5% is €50, which means per year they're going to pay €50 per year. So 50 plus 50 plus 50 plus 50 equals 200. So the interest repayment was €200. On the APR side, it's slightly different. So they're paying again 5% in interest, but this time the interest is going to be on whatever the balance is. So in year one, it's 1,000. In year two, it's 750. In year three, it's 500. And in year four, it's 250 until there's nothing left. So on your calculator, you'll have to say 1,000 by 5%, and that's €50 for year one. In year two, the balance left was €750. So €750 by 5%, and that's €37.50. In year three, the balance left was €500. So €500 by 5% is 25. And lastly, in year four, the balance left is €250. So €250 by 5% is €12.50. So to get the total interest on the APR rate, is just adding 50 plus 37.50 plus 25 plus 12.50, which means the interest is €125. So you've now worked out the interest to be paid, which is for flat €200 or for APR €125. And the last question here is hire purchase versus borrowing. So Harry Styles wishes to borrow in order to purchase a photocopier worth €6,000, and he has the following options. Hire purchase is a €400 deposit and 36 installments of €170 each, or a loan €6,000 at 7.5% APR annual percentage rate over 3 years, with the loan to reduce by €2,000 each year. So what you're asked to do is to calculate the total cost of each option and show your workings. Then you're also asked to see which would you recommend and why. So the hire purchase option here on the left, it's the initial €400 deposit plus 36 separate installments of €170 each. So that's €400 plus 36 by €170. That means it's €400 plus 6,120, which means the hire purchase option will cost Harry Styles €6,520. Now, the loan option on the other side. So again, the headings, similar to question 3 here, balance, repayment, and interest, and put your years down along the left-hand side. So in year one, the balance of the loan is €6,000. We know that the loan will reduce by €2,000 per year, which means the balance in year two will be €4,000. The balance in year three will be €2,000 until the total left is zero. There's nothing left to repay. We know he's repaying €2,000 per year. So now what we have to do is just work out what the interest would be. So what we do is the balance by the interest rate. So the balance in year one was €6,000. So €6,000 by 7.5% is €450. In year two, it's €4,000. That's the balance. So €4,000 by 7.5%, and the answer is €300. And in year three, the balance is €2,000. So €2,000 by 7.5%, and the answer is €150. When you add up the interest, 450 plus 300 plus 150, the total interest is €900. The total cost of that loan is the €6,000 original loan, plus the interest of €900 is €6,900. So we've calculated the cost of each option now, and we've showed how we got our answers there. So now, which would you recommend and why? Well, I would recommend hire purchase, as it is cheaper. And maybe just even to say, how much is it cheaper by? 6,900 minus 6,520, it is cheaper by €380. So there's a quick video to help you with your calculation questions for saving, investing, and borrowing.